Guys, there's a fair bit to unpack, so we'll start where it was relatively quiet, and that was in interest rates. Even though Australia did raise interest rates yesterday by 25 basis points, and we can see here the yield actually went down on the 10 years because the market was expecting 50 basis points. But over in Europe and the US, interest rates were pretty quiet and flat. Now, with Australia raising interest rates only by 0.25, they're well behind the global rate rising scenario, and there's reasons for that, in being that Lowe thinks that we're pretty well protected because our mortgage rates are more closely aligned to short-term yields rather than long-term yields, whereas the US mortgage stress is out at 30-year bonds, and similarly over in the UK, and therefore they have to raise rates before to try and squeeze the consumer if they're going to hit inflation. Lowe also suggesting that because housing prices are coming down, we're already seeing the effect of inflation coming out of the market, which is an interesting argument when the market's actually going into recession and inflation is still quite high. That said, we can see a big turnaround in the commodity index over here, even though iron ore, coal and natural gas is still quite low, comparatively speaking. Gold also spiked as well, and I think that's the move on the commodity index is mostly from these two. Although copper also had a good day. So it's kind of, I think, more of a dead cat bounce scenario, where we're seeing stocks get all bullish as well, because the US job openings, number of openings for jobs dropped from 11 million to 10 million. So that's going to have an effect on the jobs rate, which we're going to see on Friday night. You would expect that to flow through to non-farm payrolls on Friday night, and that increasing the percentage, from wherever they are, 3% or something, to getting up above 4%. And as I've said before and written before, is that's the purest definition of inflation, stagflation, when you've got jobs becoming harder to find and unemployment rate increasing, with higher interest rates and raising interest rates, and high inflation and raising inflation. That's pure stagflation. And once you're in stagflation, it's very hard to get out of it. Just ask the Japanese, who have been in stagflation since pretty much the 1980s. So the bounce in stocks was pretty aggressive, particularly for Australia here. With quite a large aggressive move. I think one of the largest in quite a while, and that seems to be carrying on again this morning. The market's just opening now in the futures. Sydney's been open for an hour, daylight savings. But we're also seeing that in US stocks as well. But again, I think this is just a dead cat bounce. I don't think market conditions have changed all that significantly to consider that, from a fundamental perspective, that we need to be out of the bearish sentiment and into a bullish sentiment. I think we're still in a bear trend overall, as we can see here, and I think there's a lot more of that to come. Just waiting for the next shoe to fall, I guess. Over in currencies, we're seeing that US dollar have a pretty aggressive retracement as euro got all bullish. Aussie didn't go along with it, even though they raised interest rates. It was seen as a negative sentiment, and if the commodity index had fallen, if oil and gold had fallen, you would have seen Aussie a lot lower than where it is. But I still think that Aussie is probably the weaker pair, and you want to be trading it like that. I still think you want to be fading pounds when you see selling. We haven't really seen anything yet. You can see the closing price on each of the last five bars have been quite near the high, and therefore there's clearly still strong buying sentiment there, but we will get selling at some point, and that's when you want to go with the overall trend. Similar story over here in the euro. We did see a little bit of weakness here on this day, and then we had an inside day doing nothing, but other than that it's been quite aggressively bid. But again, the fundamental conditions are still the same, and we'd be looking for a selling there. In the yen, we know that the BOJ are buyers of the yen and have a line in the sand at 145 against the US dollar. That hasn't really been breached, and be looking to buy yen off that. So looking at the Aussie pairs, Aussie yen is an opportunity. Euro Aussie, again, you've got a weak currency. Yes, it's been aggressive recently, and so has the pound, but fundamentally they're both relatively weak currencies. You want to trade a weak against a strong currency, such as the US dollar and the yen are the strong currencies right now, and everything else is pretty weak. So there's no point in trading week for week, because markets tend to go nowhere when you have a weak currency against another weak currency. Whereas if you're trading a strong currency versus a weak currency, you get these larger moves. Looking at the yen pairs across the board there, so a weak currency being the Aussie yen. You want to be looking, the euro yen has had a bit of an uptick as the euro got aggressive over the last week, but I don't see that as sustainable, and same with the pound. Those are the options, I think. Well, pretty much yen against all of the majors, particularly the commodity currencies and the European currencies. You could also look at the dollar yen. Again, to me, that's a strong currency versus a strong currency, right? So that makes it difficult when they're both attracting inflows at this, well, not necessarily at the same rate, but at a rate. They're both attracting inflows where there's an outflow against the Aussie, an outflow against the pound, versus inflows on the yen. That's when you get that disparity or the divergence, and that's where there's opportunity. So I think the moves of the last week are non-sustainable. The picture hasn't really changed. The news out hasn't been all that different, whilst the Aussie I think is a bad move by Governor Lowe, even though he's worried about the household, the impact on households and mortgage rates. Well, that's kind of what you want him to do, is stress those mortgages to not necessarily bust the mortgage market, but put pressure on household spending and drive housing prices down and get inflation out of the economy. And I think he needs to. He did say he's going to perhaps continue raising rates, but I think I think he missed the mark there, and he should have done 50. Anyway, that's my two cents worth. Hope you enjoyed the day, and I guess the next big move is non-farms on Friday night.